What's going on, everybody? And today I got another little short video, and I'm going to be going over the concept of auctions theory when it comes to trading. I mentioned it in my last video on the weekly market breakdown. I talked about a few things with auctions theory, and I said I'm going to make a separate video because I realized that most of you guys probably don't even understand what auctions theory is and understanding the difference between getting a discount on price and selling at a premium. So that's what I'm going to be going over today. And it ties into key with what the Fibonacci actually does, because the Fibonacci itself doesn't make price do what it does. It's the reason the Fibonacci, you guys will see. But let's get right on into it. So first things first, understanding auctions theory. So let me just give you guys a short little example that I gave in my last video. Also is just a simple way of auctions theory is understanding that you want to sell at the highest price and buy at the lowest price. Most of you guys have probably heard the concept before of you want to buy low, sell high. Well, that's what this auctions theory ties to at the end of the day. So let's just pull our fibs just so I can show you an example. So okay, say we're in a range or something. Let me just actually show you an example on the extra chart. So let's say right here, from this low to this high. So this is the current range we're going to be looking at, from this high and this low right here. So understanding buying low, sell high, that's what this Fibonacci does. The three levels I use on the Fibonacci, the 62%, the 70.50%, and the 79% are all the lowest levels that you would like to get into a trade. And the reason I use these levels is because these are the levels that are highly respected and at a very low discount price. And when I say discount price, if you look in the range, so think of this as a range between, let's just do it like this. I'm going to try to explain it in simplest terms. Think of this as level 1, 2, 3, 4, 5, 6, and then let's just say 7. This right here doesn't really matter. It's just an idea so I can show you guys. So you want to get the lowest price and look at this range. Where would the lowest ideal areas you would want to buy it? You would want to be buying from 1 to 3 because these are the lowest areas before you break structure. Because if you break structure, more than likely price is going to continue to go lower. So you want to buy at areas before price breaks structure. Why? Because you want to keep that market structure. You want to keep that overall trend in that uptrend. So you would want to be buying at these lower areas. And in this case, when mathematically that ties to the 62% to the 79%, and you could back test it yourself, you can see that these levels work every single day and repeatedly. They're not always going to work, but they work majority of the time. So what you would want to do if you ideally want to see higher prices, you would want to buy low. And that's what these Fibonacci levels are for. So when you're buying low, you're getting a discount on a price. And an example that I show people just to explain this to them is when you want to sell your car, you want to sell your car for the highest possible price possible, right? You don't want to sell your car at a discount. Why would you do that? And when you want to buy a car, you want to buy the car for the lowest possible price, and then you want to get a discount on that price so you're not spending a lot of money. The same thing goes into the market, because these are how the banks look at the market. When they want to buy long into the market, they want to get in at the lowest price possible to then bring it up high. So that's why we use the Fibonacci when we do. And the same thing goes for when you're selling. So the difference between buying at a discount and selling at a premium is basically at that. These Fibonacci levels, these are an area of discount that we want to be buying at the market at. So this is a discount area that we want to then buy at the market. And the best thing when buying at these low discounts is you tend to get the best risk reward possible. Because why? You're the closest to the range, the bottom of the overall range where you can have your stop loss. So 130 pips stop loss for potential all the way to the top high, which is already 290 to potentially go even higher. So the risk to reward you get from buying at these discount prices are way better. So this is an idea. This is an example of buying at a discount and using the Fibonacci. So I'm going to show you an example of selling at a premium price using the Fibonacci. So it's the same thing. You're going to look for an area at a discount where you would want to sell price. So let's just do it right here, from that high to this low right here. I'm going to mark it up so you guys can see it. From that high to this low this is the range we're looking at. And if you look at where our premium price would be, Why is it premium? Because this is the highest possible price that you want to sell at. You don't want to sell at a discount, because selling at a discount would mean you're selling somewhere down here and you're not going to get a good risk reward. You want to sell high and buy low. So that's why this Fibonacci comes in handy. So as you can see, another example, you could tell that it was wicked out a few times, but overall it was closing under the 79% discount premium levels. So why would you sell up here? Because this is the highest possible price closest to the top of the range that you want to sell at to get the best risk to reward and to sell at the highest price possible. Like I said with the example of selling your car, you want to sell your car for the highest possible price to the highest bidder. You don't want to sell it at the lowest possible price. You want to get the best possible price. So that's basically what you're doing here. You're selling high and you're buying low. So this is a short concept. There's more that goes into auctions theory, but this is just in simplest terms how we use it, because you don't need to understand exactly how it works. You need to understand the concepts that you're going to use on a day-to-day basis to get the best possible price, to get the best risk reward, the smallest stop loss for the most reward at the end. That's what we all want to do. We want to risk the least to get the most. So that's why being disciplined and being able to sell at these premium prices and buy at these discount prices with other confirmations, of course, you're not just going to use the Fibonacci, but when you have other confirmations, like I'm gonna show you, obviously I'm gonna show you guys, I wouldn't just say some bullshit without letting you know. So right here, we're going to look at this range. Okay, get that off. We're gonna look at from this high and this low. So this is the range that we're currently looking at. So where is the discount price? Since you're buying, you're looking at the discount price right here. So this by itself wouldn't be a confirmation to get into the trade, but if you look to the left, if you look at the other concepts that I tell you guys, what do you see right here? This last down candle before this up move is classified as a 1 hour bullish order block. And what do you see it doing? Where did price also come to? Now you have two confirmations in this area for price. It rejected this hour order block, rejected this 70.5 and 62% at a discount price, giving you the best possible price that you could get into the market. So that's two confirmations that you have right there. And if you look even lower and look even more in depth, and you look at right here, this candle to this candle, what did it leave behind? It left a gap in the market equating to a fair value gap. Then what did the market do from here? Right here, market left a fair value gap. So what did the market do? It came down, rejected the 1 hour order block, rejected these fib levels and this discount price that you would want to be buying long into the market, giving you the best price possible to go long, and also filled in this fair value gap before pushing all the way up. So like I said, you get the best risk reward possible. So let's say you were being conservative, you got in here with your stop below this overall swing low. So let's break that off. Let me take this off. This should be fucking me up. Right here. So say your stop loss was under here, being conservative, 119 pips. For potential, you would have at least one tick profit at this high up here. This is a 1 to 8 right now. 1 to 8, which is conservative. I ideally wouldn't have a big stop like this, but let's just say you were. For potential to go even higher, leading to a 1 to 3 before a retracement. And say even you held longer, it would go to at least a 1 to 4. So this is what I mean when you get the best possible price possible. But even then, you can see that price didn't come nowhere close to going past these levels. So even if you would have had your stop loss somewhere under the 79%, or even if you had it somewhere under the 50% of this overall order block, then like you see what I mean? If you would have had your stop somewhere under the 50% of the order block, under the 79%, you would have potentially changed your risk reward drastically. So let's just look. This is a 60-point stop for potential minimum 220, which is a 1 to 3.5 already. And then if you held even longer, this is a 1 to 6, just off the simple concept of buying low, selling high. You see what I mean? The Fibonacci itself isn't the only thing you're using to get these trades. You're using other confirmations along with it. It's not just one. There's multiple things that go along with it. So this is what I mean when I say the Fibonacci by itself is not the reason it's doing all of these things. There's other things going on in the market that lead price to go where it wants to go. And also knowing the fact that this all right here created a relative equal high, creating buy side liquidity, meaning After price kept this uptrend, rejected this all stuff, had all the confirmations where the price ideally wanted to go. It wanted to go above these equal highs, and it wanted to also go above these highs all the way up here. And that's exactly what price did, giving you the best risk reward, giving you the best possible trade possible, just off the fact of you knowing where you want to get into the market and not buying at a stupid price. And ideally knowing where you want to get the best price at, you would have been able to catch this trade off the simple confirmations just by waiting and being disciplined and following your trade plan. And things like this happen every single week. It doesn't happen every single day, of course, but it happens multiple times a week on any single time frame. The hour time frame, the 4-hour time frame, the daily time frame, even the weekly time frame. It's just, it all depends. The higher the time frame, the longer you'll have to wait for these trades. The lower the time frame, the more often you'll see these trades happen, but the more of them you'll lose. You get what I'm saying? It's a push and pull effect at the end of the day. So being able to be disciplined and waiting for price to come to these certain areas is ideally what you want to do. And at the time of day, let's check what time this was. This is 9 in the morning. You see all these confirmations. You have all these confirmations why price wants to see higher prices with time of day, 9 o'clock with the 9:30 stock exchange open. Hold on, I'm getting real into it right now. This shit, ooh, right here. I'm guessing this down candle is 9:30. Yep, this 9:30 candle came down, came into these areas, got the liquidity from under these lows right here to then push the market even higher. This is a textbook setup. Random setup, yes, but you guys could back test this yourself. I'm telling you, I wouldn't lie to you guys. I use this shit myself. Trust me. And then if you even look at other confirmations such as price on what price this is a 34,700 right here. So this is a 34,700 level, which is a whole number, psychological number, whatever you want to call it. People have different names for it, but this is just a whole number level, 34,700. So you see all these confirmations in this level, 34,700 level, rejecting our FIB, filled in a fair value gap, rejected our 1-hour order block, also with our 4-hour order block, and rejected the 50% of the 4-hour order block. Overall in an uptrend. That's 7 confirmations for this one trade, plus time of day at 9:30. Also grabbed the liquidity from under these lows. That's 9 reasons why you should get into this trade. And then you have a small stop loss because you're buying at such a discounted price. So even if you lose this trade, you're potentially risking say you're risking $100 for potential $300 minimum. That's a 1 to 3. There's reasons why you have to have confirmations and have the discipline to follow them, because it's meant to help you. When you don't follow your trade plan and you get in at random places in time because you want to catch a trade, that's when you lose more money than you're supposed to. Having a strategic way when you go into the market and understanding what you're doing and what you're looking for is the key to success. I'm telling you. So hopefully this video was a little helpful just on describing the difference between premium and discounted prices. I'm going to start talking about it more in my markup videos, but I just wanted to make sure I had a video that I could link you guys so that you could go back and watch it if you don't understand what I'm talking about in future videos when I go over the concepts. So hopefully I taught you guys something. Hopefully this is something you guys learned. Most of you guys understand the Fibonacci and understanding the retracements. But this is just the reason it's doing what it is. It's not because the Fibonacci is the reason it's going to reject that area. Because the Fibonacci is just it's just measuring retracements at the end of the day. That's all it's doing. People tend to think that this is like a magic tool, but it's not. It's a simple tool, just a lot of math behind it. But I try to break it down to simplest terms. So hopefully this video was helpful. Hopefully you learned something. And I'll see you guys in the next one. Before the video ends, I just want to let you guys know that I run a free Telegram chat that I am actively in every single morning, talking about what I expect to happen in US 30, giving you guys entry signals for when I take trades, and I do this every single day. Not every day I catch trades, but that's to be expected. But majority of the time, I'm going to have 3 to 5 trades a week, and I do this all for free. I help people. I'm actively growing this Telegram chat, and I do it all for free. So if you want to better your trading and want to learn a strategy for free and just want to have a community of like-minded traders, the link is in the description to my free Telegram chat, and I'll see you guys there. Also make sure to like on this video, comment on this video, and also make sure you look at all my other videos and concepts that I discuss on trading and how to better yourself as an individual overall. Make sure you subscribe to this channel to be actively notified when I post more videos. I post every single week, multiple times, 2 to 3 times at minimal. Also follow me on Twitter and follow me on Instagram. These are the 2 apps that I'm the most consistent on. I post my daily life. I also post trading related concepts, fitness, health, motivation, all of the above. And that's really it. So like, comment, subscribe, and I'll see you guys in the next video.